How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be taking a look at the FDIC's Quarterly Banking Profile for the fourth quarter of 2024. Now, this is a quarterly report that's put out by the FDIC, and I try to cover this report every quarter when it does come out. So if you want to go and check out some of the previous quarters, I have covered them in past episodes. If you want to go back and search through and look them up. But let's bring this up here. So this is, I give kind of the wide shot just so everybody can get a look at what this looks like. So this is the FDIC Quarterly Banking Profile. And I'm going to blow this up a little bit so it's a little bit easier for everyone to see. So this is about a 33-page report. Most of the report, a lot of statistics and stuff in here, but it's broken up into three main categories. The first one is basically how did the banking industry perform overall? So it gives us metrics on that, and then it basically goes down into community banks. Banks basically 10 billion and under. How did the community banks perform? And then finally, the third section is the DIF, the Deposit Insurance Fund, which is held by the FDIC. How is the Deposit Insurance Fund performing? So let's take a look here. So, and again, this is for the fourth quarter of 2024. So, and this is insured institutional performance. So, full bank ROA and net income improved from 2023. Quarterly ROA, that's return on assets. Quarterly return on assets and net income increased from the prior quarter, driven by higher net interest income. The net interest margin rose across all asset groups. Asset quality metrics remained generally favorable, though weakness in certain portfolios persisted. Loan balances increased modestly from the prior quarter and a year earlier. Domestic deposits increased from the prior quarter, primarily due to higher uninsured deposits. And the Deposit Insurance Fund reserve ratio increased 3 basis points to 1.28%. So what does that mean in a nutshell? Well, what happened was the Federal Reserve began to cut interest rates basically in September of last year. So as interest rates came down, interest rates on certain loan products came down, like lines of credit, variable rate loans. But unfortunately, with the Treasury rate going up, fixed rate loans did not see not much of any decline at all. But what it had a big effect on was cost of funds. Banks were basically able to reduce the amount of interest that they paid out on depository products, which really helped their net interest margin, which helped profitability, which helped expand that. But asset quality metrics remained, while favorable, though they still have weakness in certain areas. Commercial real estate still weak, particularly around office properties. We have seen some weakness in multifamily a little bit. Construction lending has gotten kind of reined in to a very real extent due to some, concerns about potential credit quality in that area. So those are some of the things we're seeing. But overall loan demand itself was very weak in the fourth quarter. But let's run through a couple of things here. Full year ROA and net income increased in 2024. So the banking industry reported full year net income of $268 billion, up $14.1 billion, 5.6% from 2023. The aggregate return on asset ratio, ROA, increased 3 basis points to 1.12%. The increase primarily occurred due to one-time events in 2023 and 2024. That led to lower non-interest expense, down $8.5 billion or 1.4%. Higher non-interest income, up $6 billion or 2%. The lower realized security losses, down $5.3 billion or 46.3% in 2024. The full year net interest margin decreased to 3.22%, down 8 basis points from 2023. Now, let's take a look here. Let's look at provision. So provision expense decreased from the previous quarter and 1 year earlier. So quarterly provision expense of $22.3 billion was down $1.3 billion or 5.5% from a quarter earlier and $2.7 billion or 10.7% from a year earlier. The reserve coverage ratio, the ratio of the allowance for credit losses to non-current loans, decreased 7 percentage points from a quarter earlier and 25.5 percentage points from a year earlier to 177.8%. A non-current loan balances increased faster than the allowance for credit losses. So this I'm not that crazy about, because basically this is what you call like the loan loss reserves. This is what banks put aside to cover any potential loan losses they may have from loans that go bad. credit quality has remained very stable, but with kind of the issues that are there in the industry and things that are potentially on the horizon, I'm not that crazy about the fact that they cut this much out of the loan loss provisions. It also begs a question about something else called CECL. What did the CECL numbers say? Did they allow for this, kind of correction in provision expenses? Just interesting things that roll through the mind as you look at some of this stuff. So, all right. This is a big one. Unrealized losses on securities increased from the previous quarter and year over year. So obviously, unrealized losses in banks' bond portfolios have been a major issue that have been plaguing the industry since the end of 2022. Unrealized losses on securities totaled $482 billion in the fourth quarter, an increase of $118 billion, 32.5% from the third quarter of 2024, and an increase of $4.8 billion, 1% from the fourth quarter of 2023. Longer-term interest rates, in particular the 30-year mortgage and the 10-year treasury rates, increased significantly during the quarter, decreasing the value of securities on banks' books. So this is a major problem for the industry, and I think as a lot of executives are starting to realize, it is not going away anytime soon. A lot of bankers have basically just been saying, hey, we're just going to hold to maturity, what's called HTM. And that may play out because in a very real way, if they do hold to maturity, they won't sustain any losses, and they'll eventually be able to kind of dig their way out of the hole. Unfortunately, because of potential liquidity issues that may arise and because of regulatory pressures, I don't know that they're going to be able to hold it out that long. They're going to have to do something here soon to they're going to have to do something here in the next year or two. I mean, there's going to be some banks that are going to be feeling some pain because they're going to have to bite the bullet to take care of this. Loan balances modestly increase. All right, well, let's get down to, I wanted to, and then this is kind of gets into kind of just the numbers and stuff that are in here as you kind of run through the report. I just want to get down to real quick. I want to take a look at community banks. How are community banks doing? Okay, community bank performance. Okay. Full year pre-tax return on assets and net income declined from 2023. Quarterly net income declined from the last quarter. Quarterly net interest margin increased from the last quarter and last year. Asset quality metrics deteriorated mostly, but remained favorable overall. It's kind of an interesting. Loan growth continued in most portfolios, and domestic deposits increased from last quarter and last year. So community banks reported full year net income of $25.9 billion, down $624 million or 2.4% from 2023. The pre-tax return on assets, ROA ratio, decreased 8 basis points to 1.14% in 2024. The decrease resulted from higher non-interest expense, up $3.9 billion or 6.1%, and higher provision expense, up $671 million or 20%, which more than offset higher net interest income, up $2.2 billion or 2.7%. The higher non-interest income, up $1.1 billion or 5.9%. The community bank full year net interest margin decreased to 3.33%, down 6 basis points from 2023. So, and then we see here, net interest margin, operating revenue increased, provision expense increased from previous quarter. Asset quality metrics remain favorable despite modest deterioration. The share of loans and leases 30 days or more past due or in non-accrual status increased 7 basis points from the third quarter of 2024 to 1.2%. Past due and non-accrual loan balances for most major loan portfolios increased from one quarter earlier, including 1 to 4 family loans, up 21 basis points to 1.27%. Non-farm, non-residential commercial real estate loans, up 4 basis points to 0.99%. And consumer loans, up 19 basis points to 2.61%. Despite the increasing trend, the fourth quarter ratio was 30 basis points below the pre-pandemic average of 1.5%. Yes, but these are not good numbers, everyone. These are not good numbers. Consumer loans at a 2.61% delinquency. I mean, basically, anything over 1% is bad. I want you to just think about it in terms of that. Anything over 1% is bad. Okay, so these numbers are definitely not trending in the right direction. Unrealized on securities increased. That continues to be an issue. Very modest loan growth. Capital ratios decreased during the quarter, down to about 13.97%. So community banks not really doing spectacularly hot there in the fourth quarter. And then finally, let's just take a look real quick. Let's see, what is the DIF doing? Okay, so the insurance fund indicator. So deposit insurance fund increased by $4 billion. The DIF reserve ratio rises 3 basis points and ends the fourth quarter at 1.28%. And one institution failed during the fourth quarter. So overall, things maintain pretty steady pace here in the quarter here for the DIF fund. So during the fourth quarter, the deposit insurance fund balance increased by $4 billion to $137.1 billion. The rise in the DIF was primarily driven by assessment income of $3.2 billion, interest earned on securities, negative provisions, and unrealized gains on securities also contributed a combined $1.5 billion to the fund during the quarter. These gains were partially offset by operating expenses of $0.7 billion. One institution failed during the fourth quarter, and I think it was a very small institution. So, but there you have it. So not terrible news. Not like, I wouldn't say like not great news, not terrible news. Just something kind of, I guess you could say something kind of in the middle. The large banks overall continue to be humming along. Community banks, having some issues. Not terribly great out there for community banks at the moment. Deposit insurance fund doing okay though. Things doing all right for the most part. Things are okay. There's some trouble spots here and there, but like I said, for the most spots, it's okay. It's definitely not terrible news. But we would definitely like to see things a little bit better. But anyway, that's all I got for you guys today. If you like this episode, please make sure to like, share, and subscribe. That helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. Have a great day out there, and I will see everyone again real soon. Thanks a lot.